So, what are some key behaviors that investors often have? And this is based on some various different research studies that have come out that are important to kind of think about. If you think about your own behavior as an investor, what are some common themes? So, number one, overconfidence, and this is a human tendency. It's natural to overrate one's ability to select winning investments. I consistently hear from those that I know that manage their own portfolios of individual stocks. I can tell you their excitement and their willingness to share their information is very much linked to when they're doing well. And those are the times when confidence is the highest and they're most likely to make an investment decision. And again, these behaviors are an important consideration in thinking about an investment plan as ultimately, or an investment structure, as it ultimately will lead to decisions that perhaps are suboptimal. Loss aversion is another. Studies have shown that losses cause about twice as much pain as gains cause pleasure. Is that practical and helpful in investment decision making? It's my personal belief that no. The idea that trying to avoid a loss is probably a suboptimal way to think about a portfolio. It's better to build a structure in a portfolio that is diversified to the point where a single loss in an individual security is de minimis in its potential impact to the portfolio. Thus, by the structural nature, you now avoid having to deal with this behavior of loss aversion. The biggest and most impactful behavior that I see, and I really think that this is the largest leader to suboptimal investment outcomes, is chasing past performance, abandoning an investment plan, abandoning a well-diversified portfolio and repeatable process because something, Bitcoin, Tesla stock, whatever it is, did really, really well yesterday. A lot of this is very much emotion linked investment decision making. It's there might be elements of greed, there might be elements of fear that I'm missing out on this incredible opportunity. Those decisions, these emotional and behavior linked decisions, or decisions that are focused really on what happened yesterday, I think are very much a suboptimal recipe for trying to manufacture positive and successful investment outcomes. Lastly on this list is timing. The idea that one can time the market, time an investment, time a sector. If there's one thing I've learned in investing over the last 20 years, it's that the underlying drivers in the short run to price are so complex and unpredictable that the idea of trying to time them really isn't logical. There's so many factors. This applies, most acutely to an individual stock, but even in the broader context of what might happen in the S&P 500 over the next 12 months, I would argue that at best trying to predict that is a coin flip. And if you're going to try to predict those sorts of things, you better revise those predictions as often as you can, because you're going to be right if you do it often enough.